Rakesh Jhunjhunwala, the big bull of Dalal Street, a name that echoes through the Indian stock market. But even the greatest stumble. Behind the glamour of success lies a series of untold stories of high stakes, bold bets, and costly missteps. From the Aptech insider trading case to the 2002 market crash, and from DHFL's downfall to Unlisted Ventures gone wrong, each mistake has a lesson for us all. What were those critical errors? And how did they shape the legend? Let's delve into the 8 investment blunders that shaped Jhunjhunwala's legacy. Rakesh Jhunjhunwala and his family began their investment in Aptech Limited in 2005 with a 10% stake. Over time, this stake increased to around 48%. This investment was seen as a strategic move to gain exposure to the education sector, particularly as Aptech expanded into the preschool segment. Economic Times and Money Control confirmed this timeline, noting that Jhunjhunwala had been involved with Aptech since 2005, starting with a smaller investment. Between 14th March 2016 and 7th September 2016, Aptech announced its entry into the preschool segment. During this period, Jhunjhunwala and his associates, including his wife Rekha Jhunjhunwala and his brother Rajesh Kumar, allegedly traded on unpublished price-sensitive information regarding this announcement. The Securities and Exchange Board of India accused Jhunjhunwala and his family of using this information to trade in Aptech shares, thus benefiting from price movements that were not public knowledge. The investigation revealed that significant financial gains were made through these trades. According to Reg Street law, Jhunjhunwala and his family settled the case by paying 37 crore rupees, which included 9.5 crore rupees as settlement charges, 5.86 crore rupees as disgorgement, and 1.7 crore rupees in interest. Money Control and Business Today corroborated these details, highlighting the financial aspects and regulatory compliance in the settlement. Rakesh Jhunjhunwala experienced significant financial setbacks due to his investments in Dewan Housing Finance Corporation Limited (DHFL). He purchased 2.5 million shares of DHFL for 34 crore rupees. By December 2018, he increased his stake to 2.46%, holding 7.72 million shares at 249.4 rupees per share, totaling approximately 192.53 crore rupees. According to Business Today, by October 2019, DHFL's share price plummeted to 18 rupees and 45 paise, reducing the value of Jhunjhunwala's holdings to about 14.24 crore rupees, resulting in a loss exceeding 178 crore rupees. DHFL faced a severe liquidity crisis, leading to delays in debt repayments and a significant drop in share value. The downturn in DHFL's fortunes significantly affected Jhunjhunwala's portfolio, highlighting the inherent risks associated with investments in the financial sector. Mandhana Retail Ventures Limited is an Indian company primarily engaged in the apparel and fashion business. The company has partnerships with well-known international brands like Calvin Klein, Tommy Hilfiger, and Pepe Jeans, among others, allowing it to bring global fashion to Indian consumers. Mandhana Retail Ventures held licenses for prominent brands like Being Human, associated with actor Salman Khan, indicating potential for brand-driven growth. According to Moneyworks' FOMI report, on 14 December 2016, Jhunjhunwala acquired 2.81 million equity shares of Mandhana Retail Ventures, representing a 12.74% stake in the company. This acquisition was conducted through an off-market transaction. According to Traxon report, Mandhana Retail Ventures experienced significant fluctuations in revenue. For the fiscal year ending 31st March 2018, the company reported revenues of 261 crore rupees. However, subsequent years saw decline, with revenues dropping to 16.07 crore rupees in the fiscal year ending 31st March 2021. According to Market Screener UK report, the company faced challenges in achieving consistent profitability. In the fiscal year ending 31st March 2021, Mandhana Retail Ventures reported a net loss of 3.10 crore rupees, a significant increase from the previous year's loss of 58.91 lakh rupees. According to Financial Express, by the September 2021 quarter, Jhunjhunwala reduced his holding in Mandhana Retail Ventures to 7.4%, holding 16.30 lakh shares. This reduction indicated a strategic exit from the investment. Over a 3-year period, Jhunjhunwala's investment in Mandhana Retail Ventures declined by nearly 94%, resulting in a loss of approximately 40 crore rupees. This case exemplifies the importance of continuous assessment and adaptability in investment strategies. – 2002 was indeed a challenging year for the Indian stock market. The BSE Sensex had dropped significantly from its peak in 2000, reflecting the impact of the global slowdown, the aftermath of the dot-com bubble burst, and domestic economic uncertainties such as the 9/11 terrorist attacks. Rakesh Jhunjhunwala, despite these bearish conditions, remained optimistic about the market's recovery. According to Money Control, his aggressive buying strategy was based on the idea that the market was undervalued and would soon rebound. Jhunjhunwala's investment strategy was criticized for being too optimistic, as many of the stocks he bought during this period did not perform well in the long term. The recovery of the market took longer than expected, leading to significant losses for his portfolio. Jhunjhunwala faced substantial losses due to his strategy of market timing. Many of the stocks he purchased during the bearish phase did not recover promptly. According to Economic Times, Jhunjhunwala's investment in Sesa, a leading iron ore exporter, was initially profitable. However, the global slowdown and domestic economic uncertainties adversely affected the mining sector, leading to a decline in Sesa stock price during 2002. This downturn resulted in substantial losses for Jhunjhunwala's holdings in the company. The losses in 2002 prompted Jhunjhunwala to reassess his investment approach. He moved from trying to time the market to focusing on value investing, choosing stocks based on their intrinsic value and long-term growth potential rather than short-term market fluctuations. According to Business Standard, in 2006, Rakesh Jhunjhunwala made a significant investment in A2Z Maintenance and Engineering Services, putting in about 20 crore rupees for a 30% stake. At that time, the company was valued at around 70 crore rupees, and Rakesh Jhunjhunwala was optimistic about its potential. Fast forward to December 2010, when A2Z went public with an issue price of 400 rupee per share. Initially, it seemed like a golden opportunity. However, the reality was starkly different. Post-IPO, the company faced severe financial difficulties, grappling with high debt and operational inefficiencies. The stock price plummeted, eroding not just Rakesh Jhunjhunwala's investment, but also the wealth of many shareholders. By March 2013, Rakesh Jhunjhunwala had to make the tough decision to reduce the stake, selling portions of my holdings in the open market. This experience was a harsh reminder that even seasoned investors like Rakesh Jhunjhunwala are not immune to the unpredictable nature of the stock market. It underscores the critical importance of due diligence and constant monitoring of investments. Rakesh Jhunjhunwala's exit from Lupin Limited in September 2021 could be viewed as a slightly premature decision, considering the company's recovery and positive developments in the subsequent years. Here's why holding on to Lupin might have been a better move. Jhunjhunwala began investing in Lupin in the early 2000s, recognizing the company's potential in the pharmaceutical sector. According to LiveMint, by June 2008, he had acquired a 4.29% stake in the company, amounting to approximately 154 crore rupees. Over the years, Jhunjhunwala strategically reduced his holdings in Lupin, capitalizing on the company's growth and increasing market valuation. According to Economic Times, by September 2021, he had fully exited his position in Lupin, as his name no longer appeared in the company's list of key shareholders. According to LiveMint, Jhunjhunwala's investment in Lupin was highly profitable. He entered when the company's market capitalization was around 500 crore rupees and exited when it had grown to approximately 44,000 crore rupees, reflecting his ability to identify and invest in high-growth potential companies. Jhunjhunwala had a substantial holding in Crisil, a leading credit rating agency, acquired when the company was relatively undervalued. By 2005, Crisil shares had appreciated significantly, providing Jhunjhunwala with substantial returns on his investment. According to Economic Times, he sold Crisil shares worth approximately 27 crore rupees in 2005. This sale was primarily to finance the purchase of a sea-facing property in Malabar Hill, one of Mumbai's most expensive residential areas. Following the sale, Crisil shares continued to appreciate substantially, driven by its dominant position in the credit rating sector and robust financial performance. By 2023, the shares Jhunjhunwala sold were estimated to be worth over 1,000 crore rupees, highlighting the massive potential gains he could have realized by holding on to them. While the decision to sell Crisil shares to buy a house might seem like a missed financial opportunity in hindsight, it was a choice that brought personal satisfaction to Jhunjhunwala and aligned with his life goals at the time. According to LiveMint report, Rakesh Jhunjhunwala admitted that about half of his investments in unlisted companies did not succeed. Despite his extensive experience and a deep understanding of the market, the unlisted space proved challenging for him. Jhunjhunwala highlighted that several of these ventures failed to deliver the anticipated returns, which was a significant setback in his investment journey. The unlisted space can be particularly risky due to the lack of liquidity, difficulty in assessing the real valuation of companies, and the longer horizon required for returns. Here are some specific examples of Rakesh Jhunjhunwala's failures in the unlisted market, according to reports and his own admissions. 1. Manpasand Beverages. According to Money Control Report, Rakesh Jhunjhunwala invested in Manpasand Beverages, a company known for its fruit beverages. Despite its rapid expansion and market presence, the company faced quality control issues, mounting debt, and regulatory hurdles. These challenges affected its profitability and stock price. 2. Subhiksha Trading Services. According to Times of India report, Subhiksha Trading Services was an investment where Jhunjhunwala's approach to retail did not pay off. The company's aggressive pricing strategy and high debt levels made it vulnerable to market changes. Subhiksha ultimately shut down due to financial mismanagement and increased competition. 3rd, Seva Mandir. According to LiveMint, Jhunjhunwala's investment in Seva Mandir, a social organization focusing on rural development, ended in disappointment. Despite the organization's mission to uplift communities, financial management and sustainability issues caused difficulties. Every legend faces failures, and Rakesh Jhunjhunwala was no exception. His journey is a testament to resilience. Each misstep he encountered was not a setback, but a stepping stone. He learned, adapted, and emerged stronger, turning challenges into opportunities. For every investor, his story is a powerful reminder that the market is unpredictable. It's not just about the wins, it's about how we respond to losses. Patience, discipline, and knowledge are the keys to navigating the highs and lows. So, As you dive into your investment journey, remember, every mistake is a lesson in disguise. Embrace them, learn from them, and build your own path to success.